And without delay, let's get started on the webinar. We have a special guest here, Thomas, who I will be introducing in the next few minutes. So let's dive in with the full agenda here. Give me just one moment while I bring in my right screen to share with you all, and I will be ready to rock and roll. Already. So welcome to Triple Cash Strategy webinar. And this webinar will help you for the fast track growth and asset protection as well at the same time. So just a little bit of disclaimer, just like most webinars do nowadays, that this material in this presentation has been prepared by and is a property of KB Tax Deviser CPAs. Neither the presenter nor this presentation creates an accountant-client relationship. And before taking any action based on this information, we strongly encourage you to consult with a professional accounting advisor about your specific situation. So let's dive in on the next slide. Who we are, a little bit about us. We are industry-leading advisory firm for entrepreneurs, business owners, providing one-stop shop solution for all your tax and accounting needs with customized, innovative strategies to help you live fruitful life, achieve financial freedom, and live lasting legacy for your family and beyond. We serve clients throughout the USA. And we are on a mission to empower smarter tax and business decisions through tax planning. As many of you know, my name is Minal Babaria. I'm the co-founder of the KB Tax Deviser CPAs along with my sister, Taruna Kanani. And a little bit about myself. I'm a CPA, certified tax coach, certified tax planner, and certified concierge accountant with more than 15 years of tax industry experience. There are millions of accountants in USA. However, only about 700 of us are certified tax coaches like me. And I'm proud to say there are only 3 certified tax coaches in Pennsylvania, and 2 of them are with our team. So a proud winner of the Gold Stevie Award for Women in Business in Accounting and Finance category, winner of 40 Under 40 by CPA Practice Advisor Award, and serving on the Intuit Tax Council member board for 2021 to 2024. Now, I know many of you accountants who have joined in this webinar. I really appreciate you. It's a great honor for me to have you all on this webinar as well. And proud member of Forbes Finance Council member as well. This is what most people think they can save in taxes. Looking at the tip of the iceberg, but in reality, what you can actually save with tax planning lies right here. I just want to launch a quick poll on just to get an idea how much taxes you all are paying. Just curious to know for my knowledge. And while you all take that poll, I'm going to go over the next slide. And, give me just one moment to move this window around. So in the last 15 months, my clients have saved $15.9 million in taxes, which is almost $16 million in taxes. And I'm really bragging about this because this is a huge achievement. And I'm very proud of my team as well as my clients who trusted on us. And, if this was not for tax planning, this money could have been literally donated to the IRS. Literally donated to the IRS. And, we are on a mission. How can we minimize your lifetime taxes to create that extra cash flow that you need for investing as well as growth? Because you all stepped into the business or real estate investment to create financial freedom or to achieve lasting legacy, right? And this is only possible if you are saving majority of your money in taxes, at the same time investing in a way which saves you thousands of dollars in taxes, plus protecting your assets for the long time. So this webinar is specifically helpful for someone who is a real estate investor. So let me close the previous poll, and thank you so much for taking that poll. And I want to go over the next poll real quick. I just am curious, how many of are you, real estate investors, and or what kind of real estate investments you are doing? So which type of the real estate assets do you own, if you don't mind taking this poll? But this webinar is highly useful for the real estate investors, high net worth individuals, business owners, of course, and anyone determined to live lasting legacy or achieve financial freedom. At the end of the day, we all have a common goal, which is to achieve a financial freedom, right? Through this real estate investment webinar series that we are starting out, our goal is to educate you all on the key things needed to succeed with the real estate investment, including some key tax strategies for paying close to zero taxes, or have to make a decision in this economy, whether to invest in real estate or to pay off your mortgage, have to evaluate those decisions. So those kind of things we want to promote and help you and guide you to make decisions in this era. So I really appreciate you all taking this poll, and I'm going to end this poll in a count of 3. So for those of you out of 21 participants, whoever has not taken it, I'm just waiting for you to take the poll. Okay, 1, 2, 3. Perfect. So let me share these results. I see majority of you are investing in single family, Airbnb, or short-term vacation rentals. Only 17% of the people is in commercial, and maybe 8% in land, 25% in flipping houses, and 25% in real estate syndications. Well, this is a really good insight. And, there's a lot that I'm going to talk about, many of this different investment in our webinar series. But, there is a lot that goes in when you are investing in real estate, whether to go residential or to go commercial, or what to do, what not, right? So at the end of the day, make your money work for you and your loved ones. And COVID has taught me a lot of things, and I'm pretty sure you all have learned a lot of things as well. You cannot win the race alone. That's my biggest lesson. And if I were to do all of these things that I'm doing, I would be far behind, playing out small and working extra, over extra hours. So leverage experts in their own field. And what I mean, whether selecting the business partners or selecting your accountant, selecting your financial advisors, it could be any and all of that. Time is, have, and will always be the commodity. And I don't need to teach you all this. You all know it. But sometimes, we are like, okay, I have money, I want to invest it, but ifs and buts cannot get you succeed in the business. Okay, so you have to go past beyond ifs and buts. And after years of struggle, I have discovered the hard way. And as you all know me, I don't like to keep things secret. If something is really working out for me, I just like to share with all of you to help all of you grow as well. And I'm so excited to share with you all and to announce that we have sourced off market through our broker relationship 80-unit townhome community, which is already under contract in Dallas-Fort Worth area in Texas. And, townhomes properties have been performing extremely well due to, high demand and little supply available in the market. And we will be doing a thorough due diligence and inspections over the next few days. And then we will set up a webinar to go through the investment opportunity. If this is something you all are interested as well, and if you want to invest, this is something really amazing that we, I have found this opportunity, and I just want to extend this deal to all of you. And I want to just see how many of you would be interested in investing in 80-unit home that you don't have to do anything yourself. All the work, everything is done by someone, and you just invest and get a return on investment just sitting at home and without doing anything. Wouldn't that be amazing? And where we have the whole team, I'm just going to launch another poll on this real estate deal. Now, if you have the whole team who is taking care of all the due diligence, making sure this is the good market, and there is high growth opportunity and the opportunity to increase the rent and whatnot. Just think about flipping the house and small residential properties and everything. It does take a lot of your time. You don't have to run behind a tenant or anything like that. So this is an interesting deal, and within 1 month or so, the opportunity to invest in this deal will be completely lost. So if this is something you're invested, do let us know. So long story short, this is something that I'm really proud of. If I wanted to go alone myself, I couldn't have done this, because we were able to find some partners who have done this for years, know the market, have the broker relationship, and a lot of things. I'm privileged to be able to invest in this real estate deal as well. So if you have been struggling, this is probably why, because you're justifying on failures, have lots of alley of fears, encourage dreams, confirm suspicions, and throw rocks at enemies. This kind of things are not going to help you grow further. Okay, so my goal for this webinar is to help you achieve the financial freedom through the investing, how you can leverage investing, create liquidity while protecting your assets. And please join me in welcoming my friend, Thomas Vicente, who is the Managing Director of the National Financial Network. And he takes a unique approach towards financial strategies for his clients, as well as extensive specialized training and development for his financial professionals. And he is a registered representative dedicated to help individuals, families, and business owners and high net worth real estate professionals develop and achieve financial goals. So please join me in welcoming Thomas. Let's see, Thomas, are you able to share your screen or hear us? Okay, how about now, Thomas? Can you try again? I'm going to stop this screen share on my side so you can share your screen. Oh, perfect. So good to see you.
Good to see you as well. And thank you so much for having me on today.
It's my honor.
Absolutely. So thank you everyone for joining and listening in. As Minal mentioned, my name is Tom Pisante, and I'm going to be talking about a pretty unique strategy here that a lot of real estate investors have taken advantage of across the country with our group. And I'm going to share my screen here. You can see my screen okay?
Yes.
All right. So before I get started with going into this, this is a newsletter that we had sent out that gives some, good information about what we do. But I want to just explain, who is this good for and who do we actually work with? So we work with a lot of real estate investors, whether you're experienced or you're just getting started, people that are involved in multifamily deals, fix and flip, or commercial investors. This is really good for these type of people. We tend to work with business owners as well, maybe ones that are individually business owners or have partners, high income earners, high net worth people such as doctors, lawyers, attorneys, other medical professionals. And what we specialize in helping these type of people with is creating tax advantaged or tax-free growth opportunities, and in the process, creating generational wealth and legacy. So what I want to just start by saying is, as a real estate investor, let's just take a look at this, right? Where are you stashing your cash, and is it in the right place? So typically what people do is they keep their money in the bank, right? And why keep money in the bank? There are some advantages, right? We have full liquidity to our money. It's guaranteed to not lose at all from time. It's not going to lose if the stock market were to drop, for example. It's uncorrelated. It's there when you need it. It's very simplistic and it's liquid, like I mentioned. But the problem is that inflation, and you're losing money due to inflation. You're losing money due to purchasing power, and of course, your money is not really growing beyond, let's say, I'll be nice and say 1%, but in reality, we know that and in this time is really not about 1% in a bank. So we have alternative places that you can stash your money with the same type of characteristics that you would want from the bank, except a lot of more benefits to that. So we have a special place. It's an insurance contract, line of credit, where you can stash your money into here. You're leveraging your money because the money is growing tax-free through dividends, and we're going to talk more about that. The money is guaranteed not only to not lose, but it also has guaranteed growth of minimally 3% and well beyond that, which we'll also dive into later on today. You're also leveraging your dollar in a way other than just the growth, because this strategy is also protecting your assets through something called long-term care. And also this contract has what's called the death benefit attached to it. So for every dollar, it's representing 3 different places, hence the term triple play cash. So we're going to talk more about the other benefits such as long-term care and the death benefit. But let's first just focus on the concept of how to use this contract and this line of credit to better position yourself as an investor when you're looking to acquire properties and go throughout your lifetime. So at a high level, what you're able to do is dump money into this contract and have access to about 80 to 85% of that money right away through a line of credit. And even though you are using that money through a line of credit to buy a property, which, by the way, from the time that you dump it in and need to use the money, it's less than a week. So it is very liquid. Even though you are using those funds to buy a property, the money inside of the contract is still growing and earning compounding tax-free growth as if you never used it in the first place. Okay, so it's a major leverage point where you can have your money working for you twice at the same time. So let's say you find a nice multifamily deal. Let's just say it's a 10% or an 8% cap rate. And you need $100,000 for that or whatever the amount is. Even though you're using those dollars, you're now getting tax-free and lifetime growth on that same $100,000 within this contract. And that's a major benefit that, unfortunately, banks are not offering. And the funny thing is, and something that Minal and I have been talking about, is that banks really don't talk about this, or many advisors aren't talking about this, but banks actually stash billions of dollars into these vehicles. And you can actually go on, if you'd like, and look up something called bank-owned life insurance, or BOLI, if you ever heard of that. They actually keep a lot of their tier 1 assets there because they know that, money sitting around is losing money to inflation. So they take those dollars and stash their money into that and then lend it out through the things that people use every day: credit cards, personal loans, car notes, mortgages, lines of credits. So we're going to talk more about that in just a moment. Feel free to hold any questions towards the end. We're going to have some time to go over that. But Minal, if you have any questions that you feel would be good for the conversation, please feel free to mention, okay?
Oops, I was muted. Thank you, Thomas. I just want to add for our listeners, if you have a question, I know there's a glitch going on with the chat box. So if you have any questions, make sure to post it in the Q&A section, or any comment, anything that you want, just put it in the Q&A section. So, technologies are good as long as they work, but sometimes it does have some glitches. So carry on, Thomas.
Absolutely. And just to kind of sum up this slide here, the major things to know is that there's a place to stash your money with taxes expected to rise. People are looking for predictable places to keep their money. And this is the most predictable place because it cannot lose due to market conditions. The way that these policies grow, just to give you an idea, because that might be a question, like how do these policies actually grow, right? So the insurance company is keeping your money very safe and they're investing in a very conservative way where they're being able to provide you with a guarantee minimally of 3%. And then as they are profitable, they provide you additional growth through dividends, which are reinvested into the policy. And the insurance companies that we are working with and designing these concepts for have never missed a dividend in their 180 plus years of existence. Okay. So these are strategies that have been proven and historically have done very well for investors over time.
So Thomas, I have a question here. How did these investments perform in, when there was a dip down in 2008 in the economy? How did it really perform?
That's a great question. If I recall correctly, I don't know the exact growth, but I do know that it was between 7.5% and 8% was the dividend that was given during the 2008 crisis. So the really nice thing about the insurance contract here is that it's not going to go up and down depending on the stock market, bond market, real estate market. Interest rates may impact it a little bit because that may impact the insurance company's profitability, of course. But when we're looking at this strategy, it's totally uncorrelated. So even if the company did not provide a dividend, it would have had growth of 3%. But because they did, the net effect was around 7.5% for that year. Makes sense?
That's interesting. Yeah, it is interesting. That's kind of just the another insight. Like, I speak to many people and they are like, okay, I have this much money sitting in the bank account, waiting for the right opportunity to invest. And they just keep the money in the bank account. Bank is not even paying any interest or anything in return. And if something were to happen with the economy that we all are in right now, or if your account gets, sacrificed through identity theft and whatnot, and, all this cyber scam and whatnot, all of a sudden you lose that money overnight.
Absolutely.
You lose that money overnight. Or if there is war or anything like that, like we saw in Ukraine and Russia, when people wanted to withdraw money from the bank account, there was a limit literally put on the bank account, $10,000 per day. That's how much you can withdraw. And that's not much when you want to leave the country or do what you want to do, whatever, $10,000, that's nothing. So it's very important to secure your assets as much as you have right now because of the phases that we all are going through. Saving money is one thing, but protecting it is the most important thing after you save your money.
I want to add something here. So that's one thing. I mean, if you are lucky enough that you don't go through ID theft or like Ukrainian war issues, even if your money is safe sitting in bank account, it's still losing its purchasing power over the time due to inflation. So I feel like real estate is a really good hedge against recession, inflation, and protect your purchasing power.
Yes, absolutely. Yes. And not to mention, a lot of people have more than, the 250,000 in a bank that is actually FDIC insured, right? So with this contract, you're actually protected from lawsuits and way more, usually 4 to 5 times more than the traditional FDIC insured amount. I know in the state of PA, it's about 1.5 million. And in other states, it's around 1 million or up to 2 million. So imagine having a place that is separate from a bank that you own, that you're in control over, and you can choose whether to add to it or not. And it's still going to grow. It's not going to lose in value, and it's protected in case, banks fail one day. These are not associated with banks. So you are protected in that instance. And that gives you an extra layer of protection and an extra place to stash your funds that you work very hard for to maintain and grow and need to use for your next real estate deal. You don't want to go to the closing table and have your account down 20%. That's not going to get it done. That's not the most efficient way to, structure your money for the next deal waiting to happen.
Absolutely. Very valid point.
Absolutely. So I'm just changing slides here. So I thought it would be smart and educational to just kind of show the three places that anyone could put money in general. And there's money that is tax deferred, there's money that is taxed now, and there's money that is taxed never. And traditionally, right now, it might be an alarming number, but over 85% of the nation's wealth right now is in before tax dollars, such as 401ks, 403bs, IRAs. And although they earned those deductions over time, taxes have significantly risen. And I believe, and Minal believes, and a lot of people believe, are going to continue to rise over time. And historically, we're actually at a pretty low point in history, of taxes. And as you know, a lot of people, are still in high brackets compared to, their income. So there's money that is obviously taxed later, such as the 401ks, where when you pull that money out, you are going to pay full tax on those. Then there are also tax advantaged places where you aren't going to pay as much tax, but you will, such as the minimal interest that you may earn in a checking or savings account, CDs, mutual funds, bonds and stocks that are in a brokerage account. You may see real estate listed there. I know a lot of the income is tax-free from real estate, but if you were to sell a property without buying another, which sometimes people will do later in life as they're, looking to spend down some of their assets, you will pay some tax and capital gains during that transition. And although it's saving you on taxes, these buckets, you're still paying about 15 to 20% of tax during that time. And then last but not least, tax-free. There's not as many places to stash your money tax-free because there's a lot of income thresholds out there. Like a Roth IRA is a great place, but anyone that is married, making over, I believe the number is 190,000 now, or single making 160, around there, don't quote me, but somewhere around there, are not able to contribute to a Roth IRA. So a majority of the people we're talking to and helping are in this boat. So, really the only other places you can put those money is if you have a Roth 401k, that's great, but only maybe 20% of 401ks out there in today's world offer those. Municipal bonds, which you may have heard about, right now, they may offer tax-free interest, but doesn't mean that it's guaranteed or that the value of the bonds are guaranteed either, because although they might be paying 2-3% tax-free interest, your principal is losing this year in an economy like we're in. So the other place that is often, I would say, misunderstood is what we're talking about today, the cash value within an insurance contract, a life insurance plan. It's the only thing that does not have any income thresholds for you. You can stash your money into there up to a maximum, depending on your age and your income. And you can take distributions from this tax-free. So as the money goes in, it could be tax deductible contribution as well, depending on how you structure things. The money is compounding and growing tax-free. And when you're ready to use the funds, you're also using those tax-free distributions. So if you're looking at these three tax buckets, what we help people do is customize the places that they're saving their money and make sure that they're not only focused on the rate of return, but they're focused on what are taxes going to look like later when I really need that money the most into retirement ultimately. Or what are taxes going to look like if I need to pull from any of these assets to fund future deals, property deals. Anything you want to add, Minal?
Oh, this is very amazing. People think, okay, I'll do 1031 exchange and I'll defer taxes to future. But in reality, that 1031 exchange may cost you even more in future, because when you can eliminate taxes, why would you defer it to future date when we all know that the tax rates are supposed to increase, right? So, I think this puts things in a very good way. Thomas, I have two questions from people, from our listeners.
Yes.
First one is, will these slides be shared afterwards?
Yes, we could share this after. Yep.
Perfect. Thank you. And I have another question, and he's asking, can we put currently owned life insurance for this particular strategy?
If you already, I'm going to answer that assuming they already have a life insurance plan.
Yes.
Even if it's not structured in the way that we're going to talk about today, as long as you are insurable, meaning your health is good and you can get approved, because this is a life insurance plan, after all, it does require that, you can move your money tax-free and without any penalties from your old contract and condense them into a new one without any harm to your cash value. So
okay.
Yes.
They have to move from one policy to another for a triple cash strategy to work.
Correct. And we will talk about taking money out of the policy through what's called a third-party line of credit. And there are approved carriers that are on the list. So if they do have one of those carriers, which I'll show later on in this presentation, they could potentially still benefit from using the line of credit feature, but their policy may not be designed the way that we're using it. So what I would recommend is, that's a great question, whoever asked that. I would say it would make sense to set up, a brief time just to have, a review of that to give you the most accurate response. Sounds
good. Thank you for addressing that.
You're welcome. I don't know if there's a third question here. That needs insurability. I see. Yes, if you're looking to get another policy or redesign it, potentially it does require insurability. But if you do have, like I mentioned, one of the approved carriers, which I'll go over later, we might be able to still have you utilize this benefit. Good questions. All right. So I'm going to dive into a case study here. I'm going to keep it high level. I know there's a lot of numbers on this, but basically on the left-hand side, it says example 1 and example 2. Example 1 is, let's just say we're purchasing a property that we're going to rent out, and it has a 10% cap rate, and it's $100,000, and we're in a 28% tax bracket. And on the right-hand side, instead of just using cash, which is what the left-hand example 1 does, we're actually going to use the example of using this insurance contract and dumping money into it and then taking money out. So on the left-hand side, we're just utilizing cash. There's no leverage. And we're earning a 10% cap rate minus the tax bracket. That gets you to a net profit of $7,200. Now, there's nothing wrong with that return. That's a great rate of return. You're able to basically almost double your money every 10 years ultimately. And there's, like I mentioned, nothing wrong with a 10% cap rate. But what if I told you with that same $100,000, instead of just writing that check and getting that property or setting up that mortgage, what if that same $100,000 was put into a different account, earning lifetime guaranteed tax-free growth for the rest of your life, right? We probably want to look at that strategy, because once we write that check or we buy that property with that cash, that's really it. We're not earning on those dollars anymore, only what it's producing through the real estate. So this is a way to earn an additional 2.5% roughly on every $100,000 that you invest, which if you just take a calculator and do 2.5% compounding every year, that's tremendous amount of wealth that you're able to create through this. So on the right-hand side, what we're doing is we're dumping 100,000 in. Like I previously mentioned, we're buying a property with the same 10% cap rate and the same 28% tax bracket. And the historical dividend growth is 7% historically over the last 30 years. And we're using a conservative rate right now of 4.25 to use the line of credit. But in reality, I will say that it is tiered. So as you have more money, it's less. And right now, our average client is between 3 and 3.5 of interest. And as I mentioned previously as well, you have access to about 80 to 85% of that right away. So in this example, we're using 85% of 100 to buy a property. So we're only having access to 85,000 initially. Okay. So let's just say we took 85,000 and we purchased a property with that. Instead, we're getting 8,500, right? 10% of that is a cap rate. We're minusing the 4.25 of interest, which brings us to a taxable income of just below 5,000, 28% tax bracket. We're netting 3,500 on the real estate deal. However, that same 85,000 that we deployed to buy that property is still earning that tax-free and compounding dividend, which is that about $6,000 in this example. So the net profit on this is actually about 9,500, which is about 2.3% more than if we were to not use this strategy. And as I previously mentioned, that is not just, 1 year, 2.5%. That's compounding every single year. And that number, it grows very large over time. I see we have a question in here. In the example, you use cash value growth rate of 7. Is it based on historical data? You only use 3% guaranteed. Policy loan rate is fixed or variable. Great questions. The guaranteed rate is 3%, which means that if the company doesn't provide dividends, you have that secureness that internally it will grow by 3%. Depending on the state that you live in as well, you could actually have your growth through an index rider off the S&P 500 with a cap of 11% and a floor of 3%. So it's a way to index your dollars with guarantees, right, wrapped around the S&P 500, which is very attractive. To answer your question, the 7% is actually just below what historically it has actually done, which I can provide data if needed to show the dividend performance. It's right around 7.5 over the last 30 years. And what I tried to do was just use a little bit of conservative numbers here to play around with this example. And the loan rate through the third party line of credit, I'm just going to explain that shortly. That is fixed or variable. You actually decide on that. Right now, the fixed rates are a little bit higher, more like 3.75 or 4%. Now, again, it is tiered. So as you have more money, it's right around anywhere from 3.25 to 3.5%. And if variable, you're using variable, the rates are actually 2.8 to 3%. So they're actually lower. And you can lock in the guaranteed rates for 3 years at a time. I hope that answered your question, Mr. Patel.
Yes, that's a very interesting question. Thomas, I think I was talking to one of the lender last week, and he's like, okay, the mortgage rates are 7%, 9%
Right.
loan rate. The policy loan rate here you have is about 4.25%. How realistic is this 4.25%?
It's very realistic. So if we decide to go directly through the insurance company to take the money, the rate maximum is 5%, and that's fixed.
Yeah.
Now, what we do is we use a non-traditional bank, third-party line of credit through Bancorp to be collateralized against your cash value, and they're able to offer lending rates at much lower than traditional banks. So right now, I would say the rate is actually less than 4% realistically, even in today's environment. And you made a great point. Imagine, if you don't have this strategy and you like to just tap into equity, right? Imagine tapping into your equity in your home and having to pay 6 to 7% interest on that, right? That's literally almost 100% more than the interest that you would be able to set up through this insurance contract. Because we're using a non-traditional bank and we're collateralizing on the safest asset class in the country, they know that there really is not as much of a risk of defaulting as traditional loans, because if you pass away, there's a death benefit that pays off that line of credit and the remainder goes to your family tax-free. So because these third-party line of credits know that this is such safe capital, they can afford to provide that lending at much lower than traditional banking. So that's a great point that you made, Manal.
Yeah, that I see that as a huge benefit, because many times people are like, okay, I want to invest in life insurance, or I want to invest in real estate. I'm in retirement side, but I don't have enough money because they're overpaying in taxes, or they're investing in businesses that they are not saving for retirement or not saving for their own life insurance if something were to happen to them. So here you can get the life insurance, invest in real estate, or invest in your business, whatever you want to do. It's like having your own cash flow bank.
Absolutely. Absolutely. And I see we have a question from Amy. Are there any fees that are charged by the insurer or third-party lender that need to be taken into account? Great question. I think that's a good time to transition into that third-party line of credit slide, but there are no fees, that we did not discuss. These are the only fees. There's a minimum contribution that you make into these plans, and that kind of wraps in the internal fees, if you will, that are associated with getting started with this contract. But there are no hidden fees or management fee that we're not discussing that you don't see on this slide here. So with that being said, this is the insurance-backed line of credit through Bancorp. So as you can see here, there are no charge for the portion of the line that's not in use. There's no application fee or closing costs. Like, as you know, if you do refinances or equity loans, sometimes there are fees associated with, there mostly are fees, I should say, associated in closing costs. With this, there are not. There's no income verification. You automatically get access to 95% of the value within your contract. And there's variable and fixed rate options available, like we mentioned before. You have check writing capability with this. You are able to wire funds as well without any cost to yourself. And this is available to be owned by businesses, trusts, or individuals. And it's, as I mentioned, it is an interest-only credit line collateralized on the insurance policy. There are a list of eligible providers here. So to answer the first person that asked the question, if you'd be able to leverage this concept, if you have one of these carriers, then you might be able to. If not, set up a consultation and I'll review and see what options you might have if you wanted to explore that, for yourself. And then I see a question here: is insurance contract loans being used? If so, is it considered direct participation, meaning does that affect future policy dividends? Great question. So the answer is no, it does not impact the growth of the policy, because we are technically not taking it from the insurance company. What we're doing is we're setting up a third-party line of credit through Bancorp, where they are lending you the money based off of the value that you have in your contract. So when you get checks, it's from Bancorp. It's not from the insurance provider. So your policy is performing as if you're never touching them, which means that your dividend is being maximized and it's growing at its most optimal rate that it possibly could, without any interest or without anything that's going against it, which would lower, the growth rate. And that's why we take from third-party line of credits, because if we take directly from insurance company, it will slightly impact the growth of the dividends. And this is a much cleaner, much more efficient way to deal with taking money out. And as I mentioned, most insurance companies are 5, 6, or 7% on their rates. And with this, we're way in control. We're under 4%, potentially under 3%, depending on how much money that we actually have, because as it's broken down basically by about 100,000 per 100,000 that you have, the rate is more on your side. It's tiered and it gets lowered.
That's interesting.
So with this insurance-backed line of credit, we're talking about ways, of course, that you can purchase additional properties with this, and that's really the most common way, I would say. But there are other things that people use this for, whether it's home improvements. Maybe you need to, improve one of your units to increase the equity, right? And you could do that. Business expansions, working capital. Maybe you just want a nice, safe place to stash money and just have compounding growth. Maybe you're not going to use it every year to buy properties, but you just want to know that your money's going to be doubling and tripling and beyond over your lifetime without taking any risk. That's definitely one way that people will set this up. And then, of course, there are unforeseen expenses, as we all know, pipes breaking, tenant issues, whatever it might be. We need to have a nice, secure place to cover those expenses. Sometimes people also look to consolidate some prior debt. Maybe they have some personal loans, or they've taken out, equity loans at high rates and they want to lower that interest in half. They can reconsolidate through this strategy. Or maybe you want to save for your children's tuition for college and you want a nice, safe place that is not counted as countable assets for FAFSA, financial aid. This is another place to store your money and to have that protection from the government on that.
Yeah. I really like how flexible this policy is. You can use it for like so many options. You don't have to just stick with one. I know when you go to the bank to get a loan for anything, like they ask a whole bunch of questions, a lot of things. So
Right.
being able to have access to the money when you really need it, and knowing the fact that your money is earning something, it's not just sitting in the bank, earning 0.0% or whatever you call it, very low negligible percentage. That is amazing.
Absolutely. And you mentioned the flexibility. So imagine somebody that wants to, let's say, put away, 100, 200, 300,000 a year. They plan to invest in real estate every year, right? So sometimes people are doing flips. Sometimes their money is tied up during times of the year. So the really nice thing about the flexibility of this contract is that you can start out with a low monthly minimum that gets started with this and gives you the ability to dump money in at any time throughout the year. And then within less than a week, take that money out when needed, tax-free. So for some people who want to put away, let's say 200,000-300,000 a year into properties, but it might be tied up, whether it's, doing fix and flips or refinances or whatever it might be, selling a property. Basically, what you can do is get started with a low, comfortable monthly minimum, usually, 1, 2, or 3,000 a month to get started, and then dump that extra excess money as it comes available. And there's no downside or negative aspect to doing it that way. The performance is still going to be strong, whether you dump the money at the beginning or whether you do that throughout the year. So the flexibility with this is, I believe, unmatched compared to other, financial strategies out there. And this is a very unique way to position your money for the future, not only to use for real estate and the things that we're talking about, but things that we're not really thinking about long-term, such as like your family with inheritance taxes, right? If you're high net worth, you need to think about, with ways to minimize that. And this is a way to do that, because part of the way with this triple play cash strategy is the death benefit component, which we're not thinking of course, while we're living. We're using the cash, but that death benefit to offset taxes later means not only you have more money throughout your life as you're doing deals, but your family is keeping the more of the hard-earned dollars that you're now passing off to them.
Yeah, it's planning ahead of time and protecting the wealth that you have built over the years. So, Thomas, how much time is needed between the time, okay, I say, for example, I opened this policy, I put money inside the policy. All of a sudden, tomorrow, there is a need and I need money right away, or I need to borrow money as a loan or whatever. How many days does it take to get the money in hand if there is any emergency?
It takes usually about 3 to 5 business days, but it could be rushed quicker as well if you needed the funds right away. What I do see is that traditionally when people are, using this as real estate investors, they usually have a 2 or a 3 week time frame where they need the funds because of, obviously doing all the paperwork and when they're going to close. So what we see is that we have plenty of time to provide them the funding that they need for those deals. And I see there's a question by Mr. Patel, will the life insurance cash values be on hold against the bank landing? No, they will not be. You can use those funds through Bancorp. So Bancorp is basically replacing the insurance company from lending the money, but you're having access to the same amount of money as if you're just going directly to the insurance company. So there's no negative side of using this or any holdup, if you will, with that. And if Bancorp ever, let's say, is not the best option, right, or the rates are not favorable anymore, we can easily reconsolidate this into another third-party line of credit, or we can always go back to the insurance company and move the funds and move the loan to the insurance company. So we have so much flexibility as well to protect you in case, Bancorp were to not become competitive anymore, or worst case, they're in a financial bind and let's say they're closing down for any reason. We can easily make some adjustments to make sure that you're not impacted by that.
That's an amazing insight. So, Thomas, tell me who this policy is good for and who this policy is not good for.
I would say this policy is best used for people who have some level of liquidity already, and they've gotten started with real estate investing and they plan to buy more properties. It's perfectly ideal for them. As I mentioned, they already have this money in their bank, right, sitting there usually, or waiting for that money to be freed up. And, they're not earning growth on those dollars over time. They're losing money to inflation. So for someone that is constantly buying more properties, this is definitely the most ideal for that person. Although if somebody is just getting started, again, you do only need a monthly minimum to just get this contract going. And when you do have those funds, you can dump them in when ready. So it is good for people that are inexperienced investors or experienced investors. But I would say who it's not good for would be somebody that, really doesn't see themselves being able to contribute and fund, 80, 90, 100,000 or more into something like this. It doesn't have to be every year, but if they don't see themselves doing that at all or buying properties, this might not be the best way to structure this for them. There might be other alternatives and ways to put your stash of money.
Yeah, this is amazing. Thank you so much for your patience and taking so many questions. And to our listeners, if you have any other questions, please put down in the Q&A for last few minutes that we have left. So, Thomas, how can people reach out to you if they need more information?
Yeah, so what I'd like to do is I'm going to email you, Minal, a link where they can actually just book themselves on my calendar. There's no consultation fees or anything like that, just to chat with me one-on-one and ask your in-depth questions or review any policies that you might have. So I can provide some information such as the slideshow that we just did today. We also have a website that I can send where they can sign up to download a report, which is about a 15-page report with information. And then, of course, don't hesitate to set up a time and chat with me. I'd be happy to answer your questions on an individual basis. And I see that somebody had a question. Can you put 50 to 100,000 lump sum and then withdraw using that immediately? Yes, you have access to the lump sums immediately. Usually you can take about 90% right away of the initial lump sum within just a couple of business days. So if you wanted to learn about that, and that if you'd like to see that scenario, I should say, feel free to schedule a brief time and I'll educate you on an example of how that would work.
That is amazing. Well, thank you so much, everyone, for joining us today. And, to go over last couple of things, give me just one moment. I think we addressed all the questions. To set up a session with Thomas, I will send you out an email in the recording that we will send you after the webinar. At the same time, if you need any help setting up the tax planning assessment, here is the link. My team can help you exactly how much you're overpaying in taxes, which specific tax strategies can apply to your situation, or what to do about implementing your strategies moving forward. And if you like, I and Thomas, we are more than happy to jump on a quick call with all of you. Right, Thomas?
Absolutely.
Perfect. Yeah, I thought so. You have been so gracious enough, to answer and address all these questions. So we would be more than happy to jump on a quick call with you to identify the best course of action on how this can work in your own personal situation. So thank you so much for joining us all today. We really appreciate your time. And the next webinar is going to be on August 10th. At 1 p.m. Eastern time zone, and I will be announcing the webinar topic very soon, but stay tuned. There is a whole bunch of webinar series that we have started for the real estate investors, no matter what profession you are in, whether a chiropractor or a marketing agency, professional service provider, real estate agent, healthcare professionals. At the end of the day, when everyone has extra money, it goes into real estate. So this webinar series is especially geared towards you. Thank you so much for your time and enjoy the rest of your day. Bye, everyone.